Imagine you are offered a business partnership where your associate provides all the initial capital for your venture. They ask for no interest for 30 years and require no monthly payments. On the surface, it looks like the ultimate leverage. However, there is a single devastating clause in the contract. At the end of those 30 years, your partner gets to decide, entirely on their own, what percentage of your total profits they want to take. They do not set the price today when the risk is high. They wait until your business is at its maximum valuation, and only then do they reveal their cut. Most rational people would never sign such a deal. Yet, this is the exact mathematical architecture of the traditional 401k and the modern pension system. We are building massive tax-deferred silos under the assumption that we are saving money. In reality, we are acting as the unpaid custodians for a government liability that has yet to be priced. This is the structural foundation of what I call the pension tax trap. I am Arlo. I have spent over 15 years working within the high-stakes world of tax strategy and wealth preservation. My focus is specifically on how legislative shifts impact the net worth of the American professional. My career has been defined by dissecting the delta between what the financial industry promises and what the tax code actually delivers. I have observed a quiet, systemic crisis brewing for those who have been the most disciplined. The very people who followed the rules, maxing out contributions and deferring taxes for decades, are the ones currently walking into a trap. This trap will trigger precisely when they are most vulnerable. As we navigate the fiscal landscape of 2026, the old logic of deferral is not just outdated, it's dangerous. The pension tax trap is a result of a fundamental psychological trick played on the American worker. It offers the relief of a small tax saving today in exchange for an unlimited tax liability tomorrow. This analysis is a deep dive into the invisible ceiling that is being built over your wealth while you sleep. The trap begins with the illusion of the deduction. When you contribute to a traditional retirement plan, you feel a sense of immediate victory because your taxable income drops. You see your account balance grow and you feel wealthy. But this is a cognitive error. That balance is a gross number, not a net number. You are looking at an account that has not yet been reconciled. In 2026, if you have $1 million in a traditional 401k, you do not actually have $1 million. You have a shared account with the Internal Revenue Service. If your effective tax rate in retirement is 25%, then $250,000 of that account already belongs to the government. You are taking 100% of the market risk for them. You are paying 100% of the management fees. You are doing 100% of the work. But your silent partner is entitled to a quarter of the gain without having risked a single cent of their own capital. This tension builds slowly over decades. It reaches a breaking point as you approach the crossover point. This is the moment when the sheer size of your tax-deferred accounts becomes a liability. Most people are told they will be in a lower tax bracket in retirement. For the educated professional, this is rarely true. In retirement, you no longer have the deductions that defined your working life. Your mortgage is often paid off, your children are independent, you are no longer making tax-deductible contributions to retirement plans. These were your primary shields against the IRS. Simultaneously, you are receiving Social Security benefits and perhaps rental income. When you add required minimum distributions to this mix, your taxable income often exceeds your peak career years. In 2026, the government's need for revenue has never been higher. The massive pool of tax-deferred retirement wealth is the most logical target for future tax hikes. We are already seeing the signals. Under recent legislation like Secure 2.0, we see the introduction of mandatory Roth catch-up contributions for high earners. The government is effectively saying they can no longer afford to wait 30 years. They need your tax dollars now. This shift is a warning shot. It tells us that the era of unlimited deferral is ending because the math of the national debt no longer supports it.
If you are 50 or older in 2026 and earning over $145,000, the law now dictates that your catch-up contributions must be after tax. This is a broader movement to Rothify the system for the Treasury's liquidity. The psychological insight here is profound. People fall into this trap because humans are naturally biased toward immediate gratification. We value the $5,000 tax saving this year more than the massive bill later. We suffer from recency bias, assuming that because tax rates have been relatively stable for the last 40 years, they will remain that way forever. But the math of 2026 suggests otherwise. A dispassionate look at the debt-to-GDP ratio suggests that the only direction for taxes to go in the long term is up. If you defer at 24% today, only to pay 35% later, you have lost the game. This brings us to the Social Security squeeze. Your pension or 401k withdrawals act as a catalyst that makes your other income sources taxable. In 2026, these thresholds remain aggressively low. For a couple, once your provisional income exceeds $44,000, 85% of your Social Security becomes subject to income tax. Every extra dollar you pull from your pension triggers a cascading penalty. This creates an effective marginal tax rate that can climb into the 40 or 50% range. It's a penalty for having saved too much in the wrong bucket. You are being taxed on your own success. We must also consider required minimum distributions. At age 73 or 75, the government's patience expires. They force you to liquidate your holdings regardless of the market conditions. These forced liquidations can push you into higher Medicare Part B and Part D premiums, known as IRMA surcharges. In 2026, these surcharges act as a sharp financial cliff. If you earn $1 over the threshold, your healthcare costs can spike by thousands. This is the ultimate manifestation of the trap, a system that strips the diligent saver of their autonomy. You are left with a massive account balance that you are afraid to touch because of the tax consequences. Eventually, the government takes the choice away from you anyway, through force. This is the invisible ceiling. It is the realization that your retirement number is a mirage if it sits in a traditional account. The weight of that silent partner is the central problem. Who actually owns your retirement? Is it you, or is it the entity that holds the power to change the tax rate on your life's work at a moment's notice? This is the core of the investigation. The discomfort of this realization is the first step towards a logical reframing. To ignore this is to accept a partnership where you provide the labor while the other party provides the rules. The realization that your retirement savings are a shared asset with the government requires a total shift in how you view wealth. Most people view their 401k as a vault. In reality, it's more like a balloon with a slow, invisible leak. To navigate the pension tax trap, we must move from identifying the problem to engineering the solution. The fundamental misunderstanding most educated Americans have is that retirement planning is about the size of the pot. In reality, retirement planning is about the control of the flow. If 100% of your wealth is locked in tax-deferred vehicles, you have zero control over your cash flow. Every dollar you touch triggers a tax event controlled by the government's current whim. To break the trap, we must adopt a three-bucket mental model. This is the only way to survive the 2026 fiscal environment. You need a taxable bucket, a tax-deferred bucket, and a tax-free bucket. The objective is not to avoid the tax-deferred bucket entirely. It is to right-size it. In 2026, the standard deduction for a married couple is approximately $32,200. This is your leverage. This means you can effectively withdraw that amount from a traditional 401k every year and pay zero federal income tax. That is the sweet spot of the American tax code. Any dollar saved in a 401k beyond what is needed to fill that 0% bracket is a dollar being set up for the trap. The most contrarian move you can make today is voluntary taxation. This is the psychological hurdle that stops most investors. We are hardwired to avoid taxes today. It feels wrong to pay the IRS now if you are not legally required to do so. However, if you accept that tax rates are likely to be higher in the future due to the $34 trillion national debt, then paying today's 22% or 24% rate is a massive bargain. This is the logic behind the Roth conversion. By moving money to a Roth IRA in 2026, you are essentially buying out your silent partner. You are paying them their cut now. You are doing this while the business, your portfolio, is at a lower valuation than it will be in 20 years. Once that money is in the Roth bucket, the government is evicted. It grows tax-free, it is withdrawn tax-free. It is not subject to required minimum distributions. You have traded current liquidity for total future autonomy and peace of mind. This is how you dismantle the trap before it closes. We must also address the hidden tax of Medicare. Many retirees believe their health care costs will be fixed, but that is a myth. The Income-Related Monthly Adjustment Amount, or IRMA, turns health care into a means-tested tax. Because RMDs and pension income increase your income, they trigger these surcharges. If you have $2 million in a traditional 401k, your forced distributions will likely push you over the IRMA thresholds. You will end up paying double the standard Medicare premium. However, Roth IRA withdrawals do not count toward this income calculation. By shifting your wealth into tax-free buckets now, you are shielding yourself from future healthcare surcharges. You are not paying taxes early. You are ensuring your future cash flow against legislative volatility. This is an analytical move designed to protect your purchasing power. Why do people fall into this trap so consistently? It is because the financial services industry is built on the asset under management model. Most advisors want your 401k to stay large. They charge a fee on the gross balance. They have no incentive to tell you to take $100,000 out, pay the taxes, and move it to a Roth account where it is harder to bill against. Furthermore, the human brain is not evolved to solve 30-year compounded tax liabilities. We solve for the immediate net pay we see in our bank accounts every Friday. To escape the trap, you must stop thinking like an employee and start thinking like a CFO. A CFO looks at the balance sheet and identifies all unfunded liabilities. Your traditional 401k is an unfunded tax liability. The practical takeaway for 2026 is clear. You must conduct what I call a tax bracket stress test on your current plan. You need to project your future RMDs based on your current balance and an average growth rate. If that projected distribution puts you in a higher bracket, you are over-concentrated. You should immediately consider a strategy of bracket bumping. This involves filling up your current 22% or 24% tax bracket with intentional Roth conversions while the rates are low. This is a disciplined, analytical approach to wealth. It is about removing the luck factor from your retirement. Most people are betting that the government will remain fiscally responsible. Given the historical trajectory of government spending, that is a very poor bet. Another critical tool in the 2026 arsenal is the Health Savings Account, or HSA. The HSA is the only triple tax-advantaged vehicle in existence. Contributions are tax-deductible, growth is tax-free, withdrawals for medical expenses are entirely tax-free. For a high-earning professional, the HSA should be treated as a medical Roth. By the time you reach retirement age, medical expenses will be your single largest line item. Having a bucket of money that is entirely invisible to the IRS, even for IRMA purposes, is the ultimate trap door out of the pension tax system. It provides total immunity. The system is designed to lead you down a path where you are a majority shareholder in name only. The pension tax trap is a slow-motion transfer of wealth from you to the state. Breaking free requires more than just saving. It requires engineering. You must be willing to pay the price of admission today to ensure that the gates aren't locked tomorrow. The difference between a comfortable retirement and a taxed retirement is found in the decisions made 10 years before the first withdrawal. Now you have the model to see the ceiling. You understand that deferral is often just another word for procrastination. In the 2026 economy, procrastination is the most expensive mistake an educated investor can make. The logic is sound, the data is clear. The window of opportunity provided by current tax brackets will not stay open forever. It is time to stop being a custodian for the IRS. I have spent my career watching people realize this too late. My hope is that by laying out the cold mathematics of the trap, you can be one of the few who exists on your own terms. The strategy is not complex, but it requires the courage to go against the traditional grain. Your future self will not thank you for the small tax break you took in 2026. They will thank you for the hundreds of thousands of dollars they don't have to share with the government in 2046. The trap is real, but the exit is already there. The math of 2026 provides a clear roadmap for those who are willing to look. You simply have to be willing to take the first step toward reclaiming your own equity.